Hi. Let's learn about counterparty, definition, types of counterparties, and examples. In the world of finance, a counterparty refers to the other party involved in a financial transaction. Every transaction requires at least two parties, a buyer and a seller. A counterparty is the other party involved in a financial transaction. For example, if you're buying a stock, the counterparty is the person or entity selling you the stock. Every transaction requires at least two parties, one buyer and one seller. The term counterparty can refer to any entity on the opposite side of a financial transaction. This can include deals between individuals, businesses, governments, or any other organization. It's important to note that both parties in a transaction do not have to be of equal standing. This means an individual can be a counterparty to a business and vice versa. A counterparty introduces counterparty risk into the equation, which is the risk that the counterparty will be unable to fulfill their end of the transaction. In everyday life, the buyer and retailer in a purchase transaction or the bond seller and bond buyer in financial markets are examples of counterparties. Counterparties can also exist in a series of transactions, like between the buyer and retailer, and then between the buyer and the delivery service when purchasing a product online. Counterparties in a trade can be classified in several ways, providing insights into how the market is likely to act based on your presence, orders, or transactions. For example, your potential counterparty can be categorized depending on your environment and similar style traders. In dealings with a counterparty, there is an innate risk that one party will not fulfill their obligation. Counterparty risk is especially true for over-the-counter transactions. Luckily, financial counterparty risk is usually mitigated by clearing houses and exchanges, which guarantee the funds or stocks involved in the transaction. A counterparty is simply the other participant in a transaction. For every buyer, there is a seller. Every transaction requires at least two parties, whether it be buying stocks or purchasing groceries at a local supermarket. Counterparty risk is the risk that the other party in the transaction will not honor the agreement and fulfill its side of the deal. Fortunately, in financial markets, counterparty risk is usually transferred to clearinghouses, making it less of a concern for individual traders. When trading stocks or other financial instruments, we seldom think about the person/business on the other side of the trade. Clearinghouses function as an intermediary in financial markets, overseeing transactions and ensuring that both the buyer and the seller honor their contractual obligations. However, it's still important to be aware of who your counterparty is, as it can provide valuable insights. Here are 3 key takeaways. 1. A counterparty is simply the other side of a trade, a buyer is the counterparty to a seller. 2. Counterparty risk is the risk that the other side of the trade will be unable to fulfill their end of the transaction. 3. In many financial transactions, the counterparty is unknown and the counterparty risk is mitigated through the use of clearing firms. Hope this would help. Thanks for watching.